Zoocasa was recently featured by Reuters in an analysis of the 50-year mortgage. Does it make homeownership easier or riskier? Let's break it down. A 50-year mortgage has been proposed by some administration to deal with housing affordability. And with home prices doubling in the last decade, the crisis is really stemming from a fundamental issue of new construction not keeping pace with demand, driving up prices, especially in high growth areas. So, a 50-year mortgage could make monthly payments more affordable and easier. However, it may not be enough to move the needle, and it may in fact make things worse for homeowners in the long run. Let's do the math. Based on a national median US home price of just over $426,000, those with a 50-year mortgage would save about $2,900 a year in payments versus a 30-year mortgage. This is assuming a 20% down payment and a 6.5% interest rate. However, if you have a 50-year mortgage, you would spend almost twice as much in interest over that same period versus a 30-year mortgage. So what does that mean? Well, your total interest paid over 30 years on a national average home price would be about $413,000. However, that same home over 50 years would cost over $770,000 in interest payments. That's a difference of $357,000. 50-year mortgages really feel like short-term gain for long-term pain. So you may have some benefit and some relief on a month-to-month basis, but in a long run, you're going to pay again almost twice as much in interest payments. So the average age of a first-time homebuyer in the US is now 40 years old. That means if a 50-year mortgage is in your wheelhouse, then you're not going to pay off your home until you're 90, with the hopes that you'll be able to pay off in your lifetime. So what do you think? Are 50-year mortgages worth it?